So today we're doing market insights question and answers based on some various questions that we've received from investment advisors over the last couple of months. So our first question has been related to inflation and the stock market. Amid all of the on again, off again speculation about a dovish pivot from the US and the UK flip flop on pivoting, are central banks near the end or the beginning of their current tightening cycle? And more importantly, what has it taken for interest rates to peak in the past? What factors could tell us when perhaps a central bank might actually be close to peaking rather than just speculation and hunches? So we went back and took a look over the 1960 to 2020 period using monthly data of what happened with what was going on with inflation and with the Dow Jones Industrial Average around peaks and troughs in the Fed funds rate. So we looked at the Fed funds rate, the inflation rate, and where the Dow was at. And the most important thing in the conclusion was not one round of monetary tightening in the last 60 years ended before the Fed funds rate was higher than the consumer price index. On average, the tightening programs ended when Fed funds was 4.5 percentage points higher than the CPI. The closest we had to parity was in April 2019, which is the last cycle. At that point in time, the Fed funds rate was at 2.44% and the US consumer price index was at 2.0%. Currently, US CPI is running about 8.5%, 9%, and the Fed funds rate, this is a little dated slide, the Fed funds rate was at 2.25 to 2.5. It's now at 3 to 3.25. So it's moved up, but the point is it's still well below where consumer prices are. One difference, however, that's important for us to remember, that's different from previous tightening cycles, is that this time around central banks are using multiple tightening tools. Quantitative tightening, or shrinking the balance sheet, has already started in both the US and Canada, and in the UK it's going to be starting November 1st. The flip-flop we saw in the UK was they were originally supposed to start October 1st, then they had problems in their financial system. They did 2 weeks of quantitative easing, ended it, and then 2 weeks later it's now starting quantitative tightening, so with a delay of about a month in the United Kingdom. So because of that, it's possible there could be a difference this time in where the interest rates peak relative to inflation, because more than one tool is being used. It's not just interest rates, it's also quantitative tightening. So here's a few cases that were of interest. 2000 to 2002. In June 2000, the Fed funds rates peaked at 6.86%. CPI was at 3.73%. The Dow had actually peaked in December of 1999 and had entered what ended up being a triple waterfall bear market. There were intermediate bottoms in March of 2000 and September of 01, and the final bottom was in September of 02. When the Fed funds peaked to the market bottom, the monthly close on the Dow declined 27.3%. So a good chunk of the bear market actually came after the Fed stopped tightening. That's important to remember. Case study number 2 is 2007 to 2009. In June of 2007, Fed funds peaked at 5.31%, CPI was at 2.69%. The CPI itself actually peaked a few months later, November of 2007, at 4.3%, at which time it was still below the Fed funds rate. The Dow Jones Industrial Average peaked in October of 2007, about the same time as CPI, and it then entered a bear market that ran through to February of 2009. So from the Fed funds peak to the market peak, the Dow climbed 3.8%. But from the Dow monthly peak to the trough Dow monthly close, it declined 50%. So once again, the bear market came, the big bear market actually came after the Fed funds rate peaked, and that's important for us to remember. And one of the reasons for that conceptually, if we think about it, is that there's liquidity and then there's corporate earnings. And so the things like the Fed fund rate impact liquidity. But the thing is that once the economy slows, CPI starts coming down, interest rates slow the economy, it has an impact on corporate earnings, and that then tends to can have a delayed effect on the stock market as well. So that's important for us to remember. Here's a series of other peaks that were of interest with the Fed funds and inflation. So in 1969, Fed funds was pretty close to double CPI, 74, 3% above, 1980, 5%-ish above, 1984, about 6%, 89, about 4, almost 5%, 94, about 3%. As I say, in 2019, it was pretty close. So with other things, this spread has also seems to have narrowed a bit over time, but we'll see what happens as this plays out. Something to note here generally, though, is that central banks are still way behind inflation. So these were some of the more recent numbers and the current numbers. So for example, we've compared here what's the most recent to where things were at back in June, which was about the last time we did a Q&A presentation during the summer. So we've just kind of updated this slide from here. So some things to recognize, for example, if we look at the US, latest CPI was 8.2%, current benchmark rate is 3.25, up from 1.75. That's the high end for the Fed's range. The 10-year Treasury yield was at 4.2%. It's come back to 4.0%, but still, the point is here that this is continuing. Even the Fed is even below the 10-year Treasury yield. So they've got a ways to go any way we slice it. And the Fed is meeting next week. They are expected to raise rates by 0.75%. This week, the Bank of Canada raised by 0.5% to 3.75. This slide was as of last Friday, so that's not included. Also not included was the European Central Bank raised its rate by 75 basis points this morning to 2.0%. That's up from 0% in June. So they're still hiking as well. And even with that, the Eurozone is pretty much sitting about the German 10-year Treasury yield, which has come down from about 2.4 to 2.2. So it's all pretty close. What's also important is this, if we look, is that this has also had a massive impact on currencies. If we look and we say, well, the US and Canada have been pretty aggressive in terms of raising their interest rates, whereas some of the other central banks have been either raising rates but at a slower pace, like the Bank of England, or dragging their feet and trying to catch up, like the ECB, or dragging their feet and making no attempt to catch up at all, which is the Bank of Japan, who actually meets tonight, by the way. And the issue, though, is that the US dollar, of course, has been steamrolling over everything. Canada is down the least against the US. Well, actually, that's not quite true. Gold is down the least against the US dollar year to date, followed by the Canadian dollar. And they're both pretty close to each other. And sometimes Canada is the least and sometimes gold is the least. They're pretty similar. The UK, however, has been seen its currency hammered, particularly most recently. The euro has been hammered, driven back under par. And the Japanese yen has been absolutely crushed. It's been taken, US dollar yen has taken a run at 150. These were levels not seen since 1990. We've had multiple interventions by the Bank of Japan trying to shore up its currency. It's under a huge amount of pressure right now with its currency collapsing. We'll see what they have to say for themselves tonight. As I mentioned, there are multiple tools that central banks can use to tighten here. And just as they used quantitative easing to boost and support the economy, we also are now seeing quantitative tightening rein that all back in. So in particular, if we look at the Bank of Canada's balance sheet, it peaked about 575 billion back in early 2021, came back, they took about 100 billion off of that to 475 in the early part of 2021. It kind of came back up to 500, but ever since the beginning of this year, we're steadily decreasing. We're back down, as it shows here, to 432 billion dollars for the Bank of Canada's balance sheet, and quantitative tightening continues. There's just to highlight some of the various headlines we've seen. Philly Fed's Harker came out and said he hasn't seen a progress on inflation and is expecting the Fed to continue raising rates. The Bank of Canada beginning asset sales in November the 1st. That was supposed to be October the 1st, so it's been delayed by a month. As I mentioned, the US dollar highest level since 1990 against the Japanese yen. These things matter. Interest rates matter, and it's just not just for the stock market, it's across all asset classes. I note here in this slide, why does inflation matter for the market? Going back historically, using over 100 years of data, we looked at annual returns for the Dow relative to the US Consumer Price Index. And it showed here with a CPI of greater than about 7%, on average, in those years that where CPI was higher than 7%, on average, you had a decline in the markets. So inflation does matter. It does have an impact on equity prices. This is an example here of the US Consumer Price Index, how we had been in a downtrend of CPI for the better part of 40 years, from the peak in 1980-81 all the way down a long period of low inflation, and now it's spiked up and it's exploded to the upside once again. And what has that also done? Well, that's pushed up interest rates and had negative impact on bond prices as well. This chart here of the US 30-year interest rate it really highlights the 40-year downtrend in US interest rates that we had. We had inflation coming down, we had interest rates coming down, and we had that massive bull market in bonds. What have we seen in the last year or so since this year, really, especially, we have seen rates explode to the upside. This long-term downtrend has ended, and rates have been 10-year rates have been soaring up above 4%. There's a big potential inflection point, big potential resistance level in and around 5%. It's a big round number. It's a psychological level. It's an area that has been prior resistance before, most significantly 10 years ago in this kind of 2008 to 2011 range before we had the last downward run in the market. So this is pretty significant level. Be keeping an eye on that should it get much closer. And where this has also had an impact this year is in swings of the 30-year US interest rate versus the S&P 500. So in the first part of this year, January to June, we had the 30-year rate climbing, we had the S&P 500 falling. Then from middle of June to middle of August, we had a downdraft in the 30-year rate. We had that summer rebound rally in the S&P 500. Then since about the middle of August, we've seen it explode to the upside again, the 30-year rate, and that coincided with a downswing in the S&P 500 as well. We've now had, over the last few days, the 30-year rate has been drifting back a little bit, as has the 10, and we have seen a bounce in the stock market. So this is still continuing to play out. How sustainable this latest move is remains to be seen. So major equity markets like the S&P 500, as I've noted, are down over 20% this year. The question now is, as we look at stock market values, is, well, and I do get this kind of question as well, are we at a bottom? Are we cheap? Are we at a point where there's value? And there's a lot of different ways of looking at that. So it's a little bit hard to consider. But we used a couple of standard rules, general rules of thumb that were out there. And one's called the rule of 20. And the rule of 20 kind of suggests that over the long term, the US stock market is kind of somewhat fairly valued if the consumer price index growth rate plus the S&P 500 is equal to about 20. Higher than 20, the market's considered to be overvalued. Lower than 20, the market is generally considered to be undervalued. So we looked at what happened this year, January 1st to October 21st. And the S&P 500 price earnings ratio has dropped, and it has come down. So we have seen nosebleed valuations come off a little bit, with a PE dropping from about 23 to about 19.5. There's the good news. The bad news is that the US Consumer Price Index went from 6.8% to 8.2%. So even though we had the benefit of a falling price earnings ratio, it was offset by an increase in inflation, and therefore this combined number has not come down as much as we might think, given the contraction that we've had in the markets. So that's something that's significant and important as we move forward, is not just keeping an eye on the PE ratio, but also on inflation. The other one to highlight, and we've used this chart in previous presentations, is what's called the Buffett indicator, and it compares U.S. stock market valuation to U.S. GDP. And as we can see, that even though we have seen things pull back, we've pulled back from what was a very extreme level. The valuation seen earlier this year or last year at that +2 standard deviation was valuation peaks that was last seen 99, early 2000s. So we've and much more outside than, say, the even where the markets were just before the COVID plunge in 2020. So even though we've come off relative to the historical trend line, this is still, it's still higher and somewhat richly valued relative to the historical trend line. And we know the 2020 bottom almost bounced off of the historical trend line. So that's something for us to consider as we're looking at all of this as well. The next question we've received is how is earnings season going so far? And of course, the answer from last Friday and the answer from today are a little bit different. So I'll talk a little bit about the economy in the news. Has been there's been a lot of bad news out there. Apple had cut iPhone production, layoffs at Intel and Microsoft. A biggie, and one we're keeping an eye on, Walmart and other retailers have canceled billions of dollars in orders and shipments. And actually that has actually been a double-edged thing, because one of the things that cancellations have done is that the logjam at the ports has actually started to clear, which is actually a good thing. So there's in some ways mixed things are a little bit mixed, and people are talking about a recession. Now, of course, that was before today's incredibly positive and upbeat U.S. GDP print that snapped 2 quarters of negative growth with a 2.6% gain over year, which was a lot more than the street was expecting. So that was actually some pretty good news for a change. And so as I say, we put this together last week, so we had things were not quite as bad as feared, and in some cases were worse. So we saw like Netflix put out results and did well in a number of sectors. This headline here, the earnings apocalypse has not yet materialized. However, last week we had a crack with Snap missing, and of course their stock plunged, just like we're seeing Meta stock plunge today. So this week, it's a bit of a different story. We have seen some worse than expected numbers, worse than expected guidance, especially coming out of the tech sector. So we saw Google, Alphabet get hit yesterday, Microsoft get hit yesterday, Meta getting hit today. Tomorrow, tonight, we have Apple and Amazon.com reporting as well. So we're still working our way through earnings season. A lot of companies have not been as bad as feared, but certainly we have seen some weakness in the technology sector. The next thing is considering the U.S. dollar. The U.S. dollar has absolutely steamrolled over everything over the last several months. And so what has been the impact of this on relative strength in earnings? And so generally speaking, the U.S. dollar, and somewhat to a lesser extent the Canadian dollar, has been soaring against major currencies for 2 main reasons. One, the Federal Reserve Board and the Bank of Canada, as I mentioned on the previous slide, have been kind of at the forefront of this hawkish tightening trend among central banks. And the second reason is that, to a certain extent, although things have been troubled and volatile here in North America, certainly today's strong U.S. GDP number suggests that perhaps the North American economy is going through a rough patch, but not a crisis, unlike other parts of the world, particularly Europe, where they have a massive energy crisis, and so things have been a little bit not quite as impacted as severely here in North America, and that's helped to support the U.S. dollar as well. In terms of the U.S. dollar impact on asset classes, generally speaking, all else being equal, a rising U.S. dollar has tended to be bullish for U.S. cash and bullish for U.S. equities relative to other markets. On the other hand, it's been bearish for gold, and that's to be expected, and other currencies. If the US dollar is strong, other currencies tend to be weak, and to a certain extent on commodities. And the reason for that is simply because commodities are priced in US dollars, and if you consider it's a world price, but the US dollar is strong, then that's just kind of a headwind for historical headwind for commodities. So I note this is another chart of the US dollar versus different currencies in 2022. So this shows with the orange line and the blue line that the gold and the Canadian dollar have been trading pretty similar to each other for much of this year. The euro has decidedly done worse, and the Japanese yen has been absolutely demolished this year as the Bank of Japan has maintained its negative interest rate policy, while Europe has gone positive and the Swiss have also has gone positive, both of them abandoning 0 to negative interest rates. And we're also looking at commodities. And so the gray line is the US dollar index, and we see commodities have kind of had their ups and downs, but more recently they've been generally trending downward. Crude oil, wheat in the black line. We have the blue line is copper, trended down over the summer. Spring has kind of been flat, and lumber has generally been trending downward since March. So we have seen in this environment where the US dollar has been rising, commodities have been falling, generally speaking. But to be fair, though, there are factors impacting commodity prices other than the US dollar, the weak demand for resources and supply factors as well. So talking now about the US dollar impact on corporate earnings. And generally speaking, this has had a significant impact, big spikes in the US dollar on earnings. Generally speaking, a rising US dollar tends to have a negative impact on exporters. We know that from Canada. It's the same thing. When we talk about the higher loonie hurting exporters, the higher US dollar hurts their exporters. It also hurts their multinationals, because when you're a big multinational company and you've got results coming in from around the world and you translate that back to US dollars, the overseas earnings come back smaller when the US dollar is stronger. It has more of a neutral impact on domestically focused companies, but just as there's a negative impact on exporters, a stronger currency has a positive impact for importers, because then it makes the price of overseas goods in US dollars cheaper. A couple of more areas we wanted to cover: seasonality in the midterm elections. The midterm elections are coming up on November the 8th, and how have US indices acted around previous US midterm elections? So what we looked at here was we've looked at all of the midterm election years from 1970 to 2022. It's actually, it is in the table is 2022, and then we've averaged them here 1970 to 2018, and then 2022 to date. So what we have seen this year is that the stock market this year has generally followed the seasonal pattern we've seen for midterm election years, but this year the swings have been bigger. So if we look down, the down months have been down more than average, and the up months have been up more than average for the most part. So if we look at, for example, June, historically a down month, average 2.5%. This June was down 6.7%. Historically, July was a rebound month with an average of about 3%, and this year it bounced more than 6%. So August has historically been a big mixed month at the best of times, but September average decline of 1.6%. This year was 8%. So we're seeing much bigger swings in both directions this year. But overall, the seasonal pattern has kind of continued to play out. A weak start to the year, a bit of a bounce in March. April was weak, surprisingly, this year. May was a little bit better than expected, but June was much worse. July much better. August and September even worse than you'd expect. And now October has been kind of all over the place in terms of returns. But historically, we have seen a bit of a lift in the markets in October, November, and December has been more of a mixed response. In particular, the December numbers, there were 2 years in particular where December was weak. One was 2018, which was the last presidential midterm, and the other one was 2002, where a major bear market was bottoming out, and war drums were pounding with the U.S. getting ready to invade Iraq, which they did a few months after that. So that's important for us to remember. So it's hard to say which way December might go, but historically we have seen in midterm years a bit of a rebound for markets in kind of October, November. And so far we're getting a bit of a bounce here, but the question is it a trading bounce or is it an actual turnaround? And that remains to be seen. The jury's still out on that one. Something else I wanted to just highlight here was with relation to oil prices and the Strategic Petroleum Reserve. One of the things we run into in midterm election years is parties trying to do things to help themselves get reelected. So in the case of this year and the Democrats, one of the big issues was the price of gasoline soaring to the moon. And so we can see here from this that there's been a decided drawdown of about 200 million barrels, or about 1/3 of the U.S. Strategic Petroleum Reserve. The question is, what happens to that after midterm elections? And that could have a significant impact on the price of oil going forward. Do these drawdowns continue, and if so, how much and for how long? And if they don't continue, does the government become a buyer to refill, or do they just leave it alone? I mean, there's a lot of moving pieces on this one, but this could have a significant impact on oil prices moving forward. And so I wanted to just highlight here, moving that into crude oil and what I call politicians' pain threshold is, and we see this often in crude oil, is when we do get massive swings up and down, often at some point in time, it triggers a response from politicians. So in the case of the big rallies we saw earlier this year when the war in Ukraine started and sanctions kicked in, and the price spiked way up to 120 a barrel, well, then the US started to increase supply through the drawdowns from the Strategic Petroleum Reserve, which I showed on the previous slide. And then we saw the oil price coming down and down and down and down. And then finally we got to about $75 a barrel, where OPEC Plus came in earlier this month with their surprise 2 million barrel per day supply cut, even though the US asked them not to, and other things, but they did it to defend the price, because at some point the big producing countries need a certain level of price, because they needed to generate taxes and keep their economy going and hit their targets and things. So there's a pain threshold on the upside for countries that are more sensitive to importing and the price of gasoline, and then the downside at some point is the pain felt by the producers, and there's a happy medium in between. But right now we're seeing this year playing out a larger range between, let's call it, about 80 and about 120. Maybe that's 75 to 125, but overall we continue to monitor crude oil for various swings in the price. The next question we've had is it too late for tactical investing? Some of you missed the boat and didn't sell earlier this year. Well, the S&P is already in a bear market. Maybe I should just ride it out, or is it still time to get involved in tactical investing? The answer is, it is not too late for defense. It's never too late for defense. Investors still need to preserve capital if they want to be able to participate in an eventual recovery, and to have a plan to distinguish between false and sustainable rebounds. And tactical works both ways. Tactical is getting out of the market when things are weakening, and then getting back into the market when things are strengthening. And we have to watch out, because we have things like the Bank of England pivoting, making a dovish pivot, and then pivoting back to the hawkish side. So there's still a lot of cross countries out there. The US has not really gone into a recession yet, or Canada, but if we do, as I showed back at the beginning of this presentation, dividends, asset prices, and the financial system could still see significant risks. I mentioned in the slides at the top of this presentation, in 2000 to 02 and in 2000 to 07 to 9, that much of the bear market declines actually came after the Fed stopped raising interest rates. So it's not too late for defense. It's not too late for tactical. And here's something else to think of as a different way: is what returns do people need to recover? And because avoiding large losses is really critical if you want to try and make your money back and be profitable over the long term. You lose 10%, you only need 11% on your remaining capital to get back to break even. Okay, but if you lose 20%, you need a 25% gain. If you lose 25%, you need 33% on the remaining capital just to get back to where you started. If you lose half your money, you got to double the rest of it just to get back to where you started. And the other issue is time, the time that could be needed to recover. This chart here shows some of the major bear markets over the last almost 100 years. And so what do we see? The depression went down 34%, market fell 90%, took 25 years to make that back. 73, 74, took 9 years, almost 10 years to recover. The 68 to 70, 76 to 78, 4 years to recover. 2000 to 02 took 6 years to recover. That was for the Dow. The Nasdaq was more like 10 years. The 12. The Dow 07 to 09 took 5 years to recover. The oddball and the outlier was the last cycle, where the market came roaring back in 9 months because of massive central bank stimulation. There's no guarantee we're going to see that happen again. That was not the norm. The norm in the last 50 years had been about 4 to 6 years, and there was one that was closer to 10 years. The other one is if we look here. So here's the example. So I was a little bit off on the Nasdaq. It actually took it 16 years to recover fully from the 2000 to 02 tech wreck Nasdaq crash. The 07 to 09, it took it 4 years to recover, and that's the volatile, super strong, momentum-driven Nasdaq. From 07 to 09, it still took it 4 years to get back to where it was. The Nikkei, 33 years, 4 months, and counting. It's never surpassed its January 90 monthly close, and flatly, it's never even really come close. And even this one here, where it had a peak in 1996, that maybe is more reasonable. It took that 21 years to get back to that. So these things can, when markets go down, they can stay down for quite a long time. So yes, it's not too late to be tactical. It's important to be tactical in these kind of times because of the high volatility in the market. In the time of things can go down and things can come back, but it can take a long time to get all the way back. And if you take a humongous loss. So on that note, that concludes our prepared remarks for today. If any of you have any questions, please reach out to us by sending an email to sales@siawm.com. We will address some of the most asked questions each month in our Market Insight. And this is our sales codes for our the funds that we sub-advise for BMO Global Asset Management. And finally, our disclaimer. So that wraps up our presentation for this month. We appreciate and thank you all very much for joining us, and we look forward to connecting with you again soon. And again, if you do have any questions, please drop us an email at sales@siawm.com. Hope you have a great day.